Good afternoon, everybody, and welcome to this webinar from the TPI Centre at the London School of Economics. The title of today's session is Transition Planning and the Route to Net Zero in the Oil and Gas and Diversified Mining Sectors. My name is David Russell, and I'm chair of the Investor Initiative, of which the TPI Centre is the academic research partner. This is one of a series of webinars that the TPI Centre undertakes every 6 to 8 weeks to showcase the work, the research, that the TPI Centre does and ensure our supporters and investors around the world are aware of what data are available, what information and analysis are available, and how those data are used. Webinars in the past have covered food producers, banking, how the TPI management quality and carbon performance data assessments differ from the Climate Action 100 benchmark assessments, and ASCOR assessing sovereign climate opportunity and risk. This afternoon, you'll hear the results of the latest Net Zero Standards Assessment by the TPI Centre on oil and gas and the diversified mining sectors. But first, a little introduction to the TPI and a little background. The TPI was set up launched in 2017, following the Paris COP in 2015, when the term transition became part of the climate lingo, so to speak. Companies were coming up to a group of investors in the UK, mainly asset owners, telling us that they had these transition plans in place, they knew what they were doing, but we had no way of assessing what they were doing, what they were telling us was true. And hence we built, a group of UK asset owners built a relationship with the London School of Economics, Professor Simon Dietz and his team, and also with FTSE Russell as a data provider, to help us develop processes to assess how companies were transitioning. I won't go into the details there, but those assessments provide, you can see this all online at the TPI Centre's, the TPI website, but those assessments provide asset owners and asset managers ways to understand how companies are transitioning, the governance processes they put in place, and how they are setting targets against that are assessed against sector-specific transition pathways between now and 2050 or Paris alignment and net zero. Those assessments are built on some really robust principles. The assessments have to be academically robust and independent, hence the relationship that TPI has with the TPI Centre at the LSE. They're based on public disclosures, so only publicly available information is used in those assessments. And the methodologies used for those assessments are also publicly available, that you can look at them on the website as well. Most importantly, the data and the analysis that we provide is currently open access, so you can download the results of the assessments. The TPI has roughly 150 supporters from around the world, representing around $80 trillion in assets under management, and many more investors actually using the data. As companies have been as companies have been setting targets, they're beginning now to set implement transition plans. And so TPI has been evolving its assessment, and that's where the net zero standards assessments come in. How are companies actually beginning to put in place transition plans, and how are they assessed? And today you'll hear about two critical sectors: the oil and gas sector and the diversified mining sector, both of which have to play their part in the transition for us to achieve Paris alignment by 2050. Obviously, fossil fuels need to be used less, so their transition is one of changing their business model quite considerably. For diversified mining, if you take out thermal coal, the metals that are produced by diversified mining companies will be critical in the transition. So that sector has to transition its energy use, its emissions, so it can align with Paris in by 2050. This webinar will go through the key findings of the latest net zero standards assessments for these sectors. And I'll now hand you over to Antonina Scheer, Policy Fellow Research Project Manager at the TPI Centre, who'll go through the agenda, introduce the speakers, cover housekeeping, and provide a brief introduction to the TPI Centre. Enjoy the session.
Great. Thank you so much, David. If we could pull up the first slide of the deck, thank you so much. So as David mentioned, in today's webinar, we'll start with a presentation from the research team. So you'll hear from Davies, who's an analyst at the TPI Centre, and Jared Sharp, who is the Centre's Net Zero Standards project lead. We can move to the slide with the agenda just as I speak through this. These two members of the team will together share their key research findings from the research that they've undertaken, assessing a sample of the largest companies in two really critical extractive sectors. These are sectors that are crucial for the transition, both from the transition risk side, but also from the transition opportunity side, as David has gestured to. So this is oil and gas and diversified mining. You'll hear a discussion of the results and their analysis. And this is all using the Net Zero Standards framework, which is really a super interesting approach that we have at the TPI Centre to take a much deeper sector-specific approach to understanding transition planning in these uniquely placed sectors. After the presentation, I'll moderate a panel to discuss how investors are using this data and also how they can support progress on transition planning in these specific sectors. Alongside Jared, we will have two speakers with particular expertise in this area. So you'll hear from Dan Gardiner, who is Head of Transition Research at the Institutional Investors Group on Climate Change, the IIGCC. And we will also have Nile, Garritson, Portfolio Manager in Sustainable Investment and Stewardship Strategies at CalSTRS, which is the California State Teachers Retirement System. I'll briefly go through some housekeeping points. So you have an opportunity to ask questions throughout the session, and we'll go through these at the end of the panel discussion. We really want the webinar to be interactive and interesting, so please do send us some challenging and interesting questions in the box at the bottom of your screen. Lastly, we will record the webinar and it'll be made available on our website, technology permitting, and we'll be sending an email to follow up with the recording. So with that, Ella, over to you. Thanks very much.
Thank you, Nina. If you go to the next slide, please, Jared. Great. So hi, I'm Ella Davies. I'm an analyst at the TPI Centre, and I supported on this cycle of analysis for the Net Zero Standards project. I'll be giving a brief introduction to the background of the Net Zero Standards project, and then I'll hand over to Jared, who will talk through the cycles of results. So the TPI Centre at the London School of Economics is the research partner of the Investor-led Transition Pathway Initiative. Here at the TPI Centre, we conduct academically robust and independent assessments of transition planning towards a low-carbon economy in line with the Paris Agreement. Our work at the TPI Centre began with the carbon performance and management quality assessments, and then we began to feed into the Climate Action 100+ benchmark. More recently, our work has moved into banks and sovereigns and deep dives into transition planning, which is what we're looking at here today. Our assessments are based on public disclosures, and the methodologies of how we conduct our assessments are made available publicly. All our data is free and open access on our website. If you could go to the next slide, please, Jared. So the Net Zero Standards framework was designed as a sector-specific bolt-on assessment framework to the Climate Action 100+ Net Zero Company benchmark. For those of you who may not be familiar, the Climate Action 100+ benchmark, which is assessed at the TPI Centre, assesses the climate-related disclosures of companies with high greenhouse gas emissions. This provides a clear framework to engage with companies on a wide range of topics, including commitments to cut emissions and improve governance. It was designed as a sector-agnostic benchmark, so to provide sort of a universal standard for comparison of companies between sectors. Contrastingly, the Net Zero Standards framework, which we're looking at here, looks to provide a deeper sector-specific consideration of the transition plans of companies in the CA 100+ universe. It assesses the transition strategies of companies in hard-to-abate sectors and the opportunities and challenges that they may be likely to face. Through the Net Zero Standards project, we aim to understand the route that a company intends to take through the transition, including how it plans to action its targets. The focus of the framework has been placed primarily on strategy and capital expenditure, with smaller sections and targets on just transition and disclosure. And this aims to provide investors with an understanding of the strategic decisions that a company is making towards its ambitions. The number of metrics assessed under each key focus area or sub-indicator in the context of this framework is weighted based on the importance of the relevant issue and the detail required to comprehensively assess each section. For example, the sub-indicators with the most metrics in the oil and gas sector framework are oil and gas production and neutralizing measures. And for the diversified mining framework, the sub-indicators with the heaviest weighting are metallurgical and thermal coal production and emissions from processing of sold products. So we're going to move on to to visualize this for the Net Zero Standards for diversified mining. If you go to the next slide, please, Jared. Great. So here you can see the diversified mining standards sort of overlaid onto the Climate Action 100+ framework. The Climate Action 100+ framework consists of a set of sector agnostic indicators, which sit in the yellow tiles at the top. And then the net zero standard follows this structure, announcing new sector-specific focus areas that integrate with indicators from the C100+ framework. Under key focus areas such as targets and strategy, sub-indicators have been designed for net zero standards that are specifically relevant to the low carbon transition of diversified mining companies. High-level categorization of these areas is represented by the tiles in blue. For example, downstream emissions captures everything from processing of sold products to downstream transportation and distribution. Diversified mining is a complex sector as companies have diverse product portfolios and each product has its own transition challenges. For example, emissions from iron ore products are currently incredibly high due to energy and carbon intensive processing. And similarly for coal, high direct use phase emissions from burning coal means that use of sub-products is a major source of emissions. To capture transition risks, we've taken a commodity by commodity approach, which allows the focus on the material elements of strategy at a high degree of granularity. This is different in the oil and gas sector framework as these companies extract a smaller number of products. Here you can see the focus has also been placed on just transition in these metrics due to its importance in the transition planning of companies in the diversified mining sector. So I'm going to hand over to Jared now. He's going to talk through the results of this cycle's analysis.
Brilliant, thanks Ella. Welcome everyone, my name is Jared Sharp. I'm the project lead for the Net Zero Standards at the TPI Centre. We're going to be going over the results from this year, which is the second publication of the oil and gas net zero standards and the first for diversified mining. Here we've assessed 7 oil and gas companies, 5 diversified mining companies, and this is in addition to the 10 we assessed last year. The numbers are a little bit smaller, but that's because these assessments are very kind of onerous to assess, but they go into a lot of detail and that's what we're going to explore here. So the first thing I want to look at is the total scores. Plotting the net zero standard scores against the CA100+ scores. So what this is trying to present is the company's levels of transition planning against the kind of top line metrics for climate action. So looking to see whether or not they have sufficiently developed strategy CapEx behind their main commitments. So the first thing that we see here is that there's a really clear geographical distribution, particularly exhibited by the oil and gas companies. In the bottom left of the graph, we see the US companies. In the middle, we kind of see the non-US EU companies, Petrobras, Woodside, Santos, that are Australian and South American. And then we've got the European companies clustered at the top doing better on both the CA100+ framework and the net zero standards framework. This doesn't hold true for the diversified mining companies in blue, which do better generally on both C100+ and the net zero standards. But while they do better on the C100+ framework across the board, the variance in terms of the net zero standard framework is much larger. So companies are normally scoring about 40 to 60% on C100+. However, their approach to transition planning is varying quite widely from sub 20% to above 60%. And this is really significant and a really good reason for the net zero standard framework for diversified mining to come out at this time. And this leads into the point of where the net zero standards really adds value. Across this entire set of results, you can kind of see a relationship between the CA100+ and net zero standards scoring. Companies with some to low CA100+ scores tend to not score on any transition planning metrics at all. And there's a good correlation until you really get to the top end here, where the relationship between scoring on these kind of high level metrics and the transition planning behind that kind of breaks down a little. So we see in this kind of top area for both diversified mining and oil and gas, some companies, there's this kind of grouping of companies scoring 40, 50, 60%. However, there's real disaggregation in the net zero standards between some of these companies. So some of these companies are making a lot of high level commitments, but what this data is showing is that these are not all equal, that there is disaggregation here if we take a more granular approach. And this is what the net zero standards is really here to do. So let's Quickly focus in on the oil and gas sub-indicator results. So this is the 7 oil and gas companies broken down by sub-indicator. So these are the sub-indicators listed down the left and the percentage of metrics scored overall. If you were here last year, some of the messages on this slide are going to be very similar. Methane and emissions disclosure, still the only 2 sub-indicators that are doing really well. Generally, it's fairly poor performance across the board with some green shoots in terms of CapEx. It's still quite disappointing to see climate solutions and production metrics scoring sub 5, 10%. These are absolutely crucial for whether or not companies are going to survive the transition, how their emissions are going to change over time, and the amount of transition risk that they're going to be exposed to. It's also very interesting down the bottom in the disclosure section. While the emissions disclosure is increasingly being legislated and companies are scoring quite well on this, energy disclosure remains a kind of obtuse aspect of a company's disclosure set. It's not that companies aren't disclosing on this, it's that they tend to involve factors like fossil fuel equivalence transformations, also known as pass-through substitution methodology, and traded product that can be very impactful to their disclosure, but they're not being clear about some of these factors and how they go into the company's aggregated energy disclosure. If you want to hear more about that, TPI will be publishing a research paper either this month or next month on FFEs, so look out for that. Over to the diversified mining sector, we see generally more positive results. As David said, good performance in climate solutions where it is crucial, and these are growth areas for the company, but also in operational emissions and, interestingly, shipping in the kind of downstream portions. Alternatively, well, on the other side of that coin, there's still not been very much progress in methane, and we'll speak about that in a bit, and also on metallurgical coal, which is quite interesting because in the strategy section, section 5 and 6 of thermal and metallurgical coal, we can see better performance in thermal coal production than metallurgical coal. And thermal coal production, we know, is probably going to be declining in usage at the present into the 2030s. And in most Paris-aligned scenarios, almost ceases to be used for energy production. And this isn't the case for metallurgical coal. The use case and the demand for that stretches far longer. What's interesting is that companies, because of this, seem to want to talk about metallurgical coal less. And I think it's an interesting result that companies are discussing CapEx surrounding this less, because it's seen as potentially a hot topic or something that is contentious. And I think it's something we can all work on to make sure we really understand the nuances between individual kind of product and commodities and their long-term uses in the transition and how they're going to be, or at least how their production is going to change over time, so that companies feel more confident in talking about these specific aspects. Because there's no reason why metallurgical coal should be something that is not discussed when talking about transition plans. It's going to be a key aspect of transition risk, and it is going to continue to be a commodity over the next couple of decades. However, in order to look at this and really evaluate the use case for it, we need clear information about where it's going, what companies are planning to do. So just a quick focus in the just transition for the diversified mining sector. And we've touched on this a little bit already, that some of the kind of low-hanging fruits are already being grabbed up and planned into by companies into the disclosure. And this is very much the case for just transition. The kind of top-line commitments to address allegations of human rights and mitigate the risks of future abuses has been committed to by all the companies that we assessed. Some of the slightly more reaching metrics in terms of committing to achieving responsible mining certification for all mines, and also disclosing a timeline to do so. So this isn't just an empty commitment. This is really, I don't want to say rigorous, but a firm commitment to deliver something that companies are starting to get on board with, despite, to be honest, structural problems with lead times for certification and high costs due to a low number of suppliers. However, some of the more practical metrics, including disclosing an annual budget to implement a just transition plan, is still not being discussed. And as I'm sure you can see from the metric title, this is an absolutely crucial thing to understanding a company's approach to just transition. And the fact that no companies are willing to disclose this really practical thing is quite disappointing and means there's a lot of work to go in this area. I know this slide is a little bit busy, but bear with me. I want to show why a sectoral comparison is really, really important. So we've talked about climate solutions being one of the best scoring sub-indicators for the diversified mining sector and one of the worst for oil and gas. And this isn't just because diversified mining companies have decided that they're going to be brilliant in this. There are a lot of structural considerations. The climate solutions in diversified mining tend to be growth areas for the company, transition metals that they know are going to form a large part of their product portfolio in the future, or existing products that they're looking to decarbonize. There doesn't have to be a huge amount in the structure of the company or the products they're selling in order to talk about this, in order to put money towards this. And that explains a lot of the kind of high level of scoring that we see this. In oil and gas, the opposite is true. Climate solutions is quite an existential discussion in oil and gas companies. These are often quite different products from what they traditionally produce, with lower margins and different skill sets. So it does make sense as to why these companies are scoring much lower. So the sector-specific lens here is super important. The reverse is true when we talk about methane. For oil and gas, methane abatement is one of the lowest cost abatements tools possible to the company. It allows them to save money, keep the product in the pipes. It tends to be point source. And while there's a lot of challenges to it, it is one of the cheapest abatement sources to them. So obviously they've been doing this a lot more. In mining, it's pretty much the opposite situation. Methane is emitted from coal mines, so it tends not to be from a point source. It is technically challenging to abate and quite expensive. So it's always worth taking a sector-specific consideration. If you look at the percentages just of, for example, BHP and Woodside and Santos, you might think their approach to methane is broadly similar, but you really have to couch this in how they're doing relative to their sector peers to get a good idea of how the company is doing on any particular area. So we're running out of time, so I wanted to do a couple of takeaways. So just in terms of what is on the horizon for transition planning, we've heard a lot of prevailing narratives that companies are pulling back on transition planning and climate action as a whole. And while there have been a couple of very high profile cases of this, the results of the standard suggest this isn't happening en masse across all kind of areas. There are still leaders, and kind of the total results that I showed on the first slide demonstrate that. However, we do know that some companies are pulling back. And what this means is the disparities in transition readiness are increasing. And that's really key. If you're an investor looking at a broad range of equities, the risks for these companies, the transition risks in particular, are growing between the companies who are going to be prepared for this and have plans and they're implementing them, and the companies that are backing off and being more cautious. And I think that's really important to note here. As I said, with the just transition, the easy wins of transition planning are starting to be captured. However, the more challenging topics, the technically difficult ones, the expensive ones, remain really poorly covered. We need to see more and more engagement with these topics from pretty much everyone involved in this. And throughout all of this, a sector-specific lens is really, really important to capture the nuances of the transition. If you're using methodologies to assess transition planning, you need to go beyond metrics that just look at, has the company identified its decarbonization levers? What are they doing with their methane? Because as we see, these are very different questions depending on the sector you're looking at. With that, I'll wrap up and we can move into our Q&A session. So I'll hand back to Nina. Thank you very much, everyone, for listening.
Thanks so much, Jared. I think the presentation from you and Ella is a really great foundation for the discussion now, and hopefully we can get more questions coming in from the chat from participants. I also want to mention you noted the importance of sector-specific approaches, and in particular the differentiation between metallurgical coal and thermal coal. And this is actually the focus approach that we have in an upcoming coal-specific methodology note for carbon performance, which is a subset of tools that we have at the Transition Pathway Initiative Centre, which assesses the emissions pathways, historical and forward-looking targets. So keep your eyes peeled for that. Now turning to the panel, Dan, I'd like to start with you. So focusing on your role at IIGCC, where we understand you represent investor perspectives and particularly institutional investors. From that perspective, what is distinct about the net zero standards among other tools that they have access to, and focusing in on these particular sectors, where is the sector-specific approach fitting into those investor priorities?
Thanks, Nina, and good afternoon and good morning, everyone, as appropriate. So thank you firstly to Jared and the team for the presentation and the TPI more broadly for its work here. I think this lens, I mean, Jared's done a good job of it already, but it just highlights how business critical the transition is in these sectors. There's anything between 0 and 100% of value at stake. You know, some of the companies going into this transition are not going to be the ones that are emerging on the other side, and so you do need a robust way of interrogating those transition plans, and that's what this sector-specific lens does. And you can ask generic questions, and you know, with the state of disclosure and the state of transition in many regions of the world, those will tell you a reasonable chunk about where a company is and how it's positioned and how it's going to go forward. But as we go deeper into the transition, differential strategies are going to emerge. Companies are going to be at different stages, and neatly, you know, captured by Jared's slide, that you can begin to see some of those disparities between where companies are disclosing and taking this stuff generally seriously, and just kind of meeting the, you know, at a very early stage. And I would highlight two examples of this. So in the oil and gas sector, the oil and gas companies come in different forms, like integrated companies, oil upstream E&P guys. They have different strategies. Some are intending to diversify, others maybe just continuing production, increasing biofuel, potentially to reduce scope 1 and 2 emissions. It's impossible to collect and understand and interrogate and engage with companies using the sectors without a sector-specific lens. So that would be one example, and the other one is the methane data that you highlighted. I mean, this is really interesting data because the methane conversation has been a live one for investors in oil and gas for a good few years now. But actually, the methane exposure in coal production is equally significant, and yet and it's been somewhat neglected where we are. And this kind of data just kind of shows where companies are in that position. Sorry, in that on that topic. So, again, these are what emerges from a sector-specific lens.
No, thanks for that. And it's useful to know, in a broad sense, the differentiation that this approach offers is useful to institutional investors. And speaking of which, Nile, from your perspective as one of the tools, maybe among many that you use as a portfolio manager, can you explain some practical examples of how you use specifically the net zero standards assessment data, noting that it's a relatively small universe of companies, but where are you finding it most useful?
Yeah, absolutely. Thank you for having me on. Good afternoon to everybody in Europe, and good morning to everybody in North America. It's also nice to see some friends in the attendee list here. I guess the short answer is, that we use the indicators and assessments as a starting point or kind of a treasure map rather than an ending point. You do see a lot of red. in some of the indicator areas. And, you know, we tend to just mentally, as a framework, see the red as an opportunity more than some sort of structural or permanent shortfall. But just to give you some quick context for how we invest, before I give you a little bit more detail, we do index the vast majority of our public equity exposure, and that is by far our largest asset class exposure for CalSTRS as a fund. So as a result of indexing, you know, we are passive shareholders of these companies. We don't actively buy and sell, but we are extremely long-term as a result. So we're going to be exposed to them throughout the duration of the transition for years and probably decades to come. The other aspect of it is that we, by definition, as a result of indexing, own literally thousands of publicly traded companies. So it's a tremendous amount of ground to cover. And we do know some of these companies extremely well, but there's others that frankly we don't. And so that's where the assessments are very helpful as a starting point, or a treasure map, as I mentioned. Because it gives us a lot of research has obviously already been done. And so we can look at the assessment spreadsheet and just quickly, you know, go down how a company is scored across the various indicators, which helps us zero in on areas that are challenges and also opportunities, which is, again, really how we look at it. And maybe I could give you just a couple examples here of what I mean by that, in terms of referring to them as opportunities as opposed to sort of structural and permanent shortcomings. Let's take like Phillips 66 and Marathon, for example. You know, they're both American companies, they're both refiners, or at least they're known as refiners. You know, I think generally, you know, the European and Australian companies in the sector tend to, on average, be a bit more progressive than their American peers. We certainly see that reflected in the scoring. But also refining tends to be more challenging than, say, upstream, where you have more of an opportunity set around methane and flaring, which is very cost effective to abate. So as we dig in on Phillips 66 and Marathon, for example, you know, as you get into indicators like number 5, decarbonization strategy and so forth, there's a lot of red, right? So what we do then is we say, okay, well, that's where we need to focus. And within that, we start asking questions like, well, you know, are they truly just refining businesses? Are there really just limited opportunities to decarbonize their existing operations, for example? And what we find is that, well, yeah, there's some truth to that. For the refining segments in their businesses, they do own significant natural gas and NGL midstream businesses, which do have a significant role to play, not only in their own methane emissions, but also the flaring intensities of their upstream customers in the lower 48. And clearly there's a significant business case for reducing flaring and playing a role in that, and reducing methane emissions. You know, both of those sources of emissions represent lost revenue to the upstream customers. They also represent lost processing and transport fees for these midstream businesses directly. And so once we're, you know, then suddenly we're on a footing where we can have very constructive engagement with these management teams. I guess in the interest of time, I could leave it there, but hopefully that gives you a little bit of indication of how we use the assessments.
Absolutely, yeah, thank you. And I think understanding that this level of detail is also particularly helpful for engagement, for shareholder engagement, is really useful to understand. Maybe Dan, coming back to you. This is actually the first year that we're launching data on diversified miners. And we can understand this sector is fundamentally a growth sector when we think about the transition. And usually in these climate discussions, we're talking about transition risk and climate risk, but this is in fact also an area of investment opportunity for investors. So thinking about that, and maybe I would like to also recognize the importance of the just transition indicators in this perspective. So there is an opportunity, but it needs to be done in a way that doesn't harm vulnerable communities affected by an expansion in mining activities. So having that just transition element there is really crucial in this opportunity lens. But coming back to you, how does the net zero standards help with interpreting that opportunity in that sense?
Okay, yeah, thanks, Nina. So yes, there's a bit of both in the mining sector. I mean, I think if we were going back 5 years ago, there was a lot more coal in the top 10 mining companies than there are now. So there's definitely the risks on that side as well as the opportunities for these guys. But certainly focusing on the opportunities, and this is where it's really great to see this data. It is a really interesting topic for us and our members right now. And I think as a community, as you said, investors have focused initially on the transition risks. But if you think about the transition as a system change, we need to have the fossil fuels ramping down and them to be substituted by alternative activities. And you can't have one without the other. And so many of our members have, over half of our members, in fact, have used the platform called the Net Zero Investment Framework, or NZIF, and to help manage and understand the roadmap towards net zero. And the NZIF asked them to do two things: essentially, look and understand the emissions intensity of their portfolio, but also to increase or set targets around climate solutions exposure. And what this data, and we haven't really kind of, this has been a very difficult topic for investors to kind of tackle, because they don't really have the data to do that at the moment. They have various taxonomies out there, but it doesn't help them set targets so much. What this does help and signals a direction towards is a kind of treatment of climate solutions as here's the opportunities, and here's how companies in those spaces could and potentially grow. So miners have exposure all to a bunch of key transition materials. And what the framework asks them to do is just to firstly disclose that exposure, and then potentially, where appropriate, set targets for growing that exposure, and to say how much they're investing in it. So there's not only a strategy to decarbonize and the actions you need to take there, but there's a strategy to grow those opportunities. And we've been really pleased with the engagement of the industry in this space, because they've actually been able to meet a lot of, as Jared says, kind of a lot of the disclosure indicators there. That said, there are two other kind of, there's kind of an eligibility, as it were, for climate solutions, but there's also a need to make sure that the growth, the new mines that might need to get built, come with just transition kind of caveats and operational emissions caveats. There's also a very interesting climate solutions exposure on the oil and gas side, which we can talk about, but I'll kind of leave it there for the moment.
Sure, thanks. No, that's really interesting. And maybe zooming out a little bit, thinking about messaging and the narrative here on climate change. So Nile, we understand recent political developments. It's really hard to watch what's happening in the US right now on a lot of different fronts, including climate change. But there's also changing economic conditions in other places, and coming back to the US, also the tariffs. So here in this context, the focus on the transition to net zero is being diverted, to put it very mildly. In your engagements, maybe in particularly in your engagements with companies in these sectors, but also more broadly as you speak within that you explain the importance that this remains a priority.
Yeah, thank you. By the way, my feed froze there for just a moment during the question, but I got the gist of it, and you can get me back on track if that happens. But yeah, fully agree with the premise of your question. Of course, it is a very challenging time on these topics, and there's also no question that there is some hostility out there to the E, the S, and the G. For starters, but our focus on these issues has always been grounded as shareholder value, as effectively permanent shareholders of virtually all these companies that are covered in these assessments. And there are several things that we continue to stay focused on in our discussions with these companies. Number one, I guess first and foremost, is that these companies, by and large, are going to be around. They've been around for decades. They're probably going to be around for decades, and we're going to be shareholders for decades. And so what we don't want is a business strategy playbook in any facet of their business that changes every 4 years based on the presidential election cycle in this country. What we want is consistency and durability in the business planning of the companies that we're shareholders in. So that's number one. Number two, and for a host of reasons, you can go kind of across the board. Climate and emissions is certainly one of them, but we want the companies to have very strong balance sheets to endure volatility from whatever the source is. It could be, obviously tariffs today, potential impacts to energy demand from that, certainly vulnerability. There could be carbon pricing or other sort of unforeseeable or slightly more ambiguous sources of demand destruction in the future. There could be oversupply situations driven by, say, OPEC wanting to bring back barrels that they'd taken off the market. So there's just all the reasons in the world for the companies to focus on having strong balance sheets. And then finally, there are aspects of decarbonization planning that are durable and make economic sense, no matter what your political views are, no matter who's in the White House. And again, I would go back to, in particular, methane and emissions and flaring emissions, which is, I think, Dan mentioned a moment ago, or I think it was Dan, excuse me, have a very, very high level of cost effectiveness when it comes to abatement. And in some cases, even a lot of cases, have the potential to pay for themselves. So that's really the essence of it. It is a bit lonely. We know that not as many investors are talking to companies about these issues as there were 3, 4, 5 years ago. That is true. But we're staying on it. And then I guess finally, the other thing we do remind the companies of, even though they may not need to be reminded of it, is while there is political volatility, certainly change has happened with the last presidential election here in the U.S. The shareholder bases of their companies, the people who own these companies in aggregate have not really changed very much at all. And so we expect the business planning and the consistency associated with that to reflect sort of the consistent nature of the shareholder bases as well, the global shareholder base, the global nature of the shareholder bases.
Thanks for that. It's good to hear that you're still on it, even if the space is a little lonelier now. But yeah, that long-term perspective is also kind of a bit of a relief in some ways, at least. Thinking in those terms can help reprioritize. Jared, I wanted to come back to you just to think through a little bit of the nuts and bolts of the assessment process. So what are some recurring research challenges, and maybe also differences between this year compared to the last year's assessments, and possibly reflecting on some of Nile's observations, how the space has changed in this limited sample of companies, but they're probably representative to some degree.
Yeah, thank you, Nina. So in terms of challenges for data gathering, there's been a couple in the Q&A section in terms of evaluating CapEx. And speaking to that, it's one of the challenges for this area is generally low data availability. Often companies don't want to talk about these topics. And historically, these kind of strategic decisions and long-term CapEx decisions have been kept behind closed doors. And that continues to be the case. We're kind of teasing some elements out for some of the European companies, particularly as this disclosure is more mandated. But outside of this geography is far less prevalent. In terms of how this iteration has been different from previous ones, I think this effect has been maybe compounded a little bit. We spoke about how not all companies are stepping back from targets, but companies are certainly engaging with people like TPI much less. In terms of the companies, we send all our results to get feedback from the companies, to just double check that our view and our interpretation of their disclosures is accurate. And so normally for these companies, like most companies will reply to that, push back on some places, give us more information. However, this year, whereas normally it might be 80 or 90%, it was only slightly above 50% this year. So it was quite a change in how companies are engaging with the kind of data providers and assessors in this way. And also, as much as it an additional challenge that we face is companies will quite aggressively push back on some of these things. And so last year, just before the publication, companies wanted to discuss with us these results. They wanted to quite vehemently fight their corner over some of these individual scores, and we got absolutely none of that this year. So I think companies are very happy pulling back from these discussions more publicly. And I think they might think investors are less interested, or it is for a matter of safety. I really hope our audience is willing to prove them wrong. But I think that's been the majority of the changes over the last year. And yeah, Nile absolutely got it right in what he covered.
Thanks, Jared. That's really interesting. There's as you say, a little bit of green hushing potentially. And we'll continue to monitor this at the TPI Centre. We have also different debates internally about what level of caveats do we accept when a company states a net zero target, and at what point does it no longer become a commitment. So following this is definitely one of our research priorities. I'm very glad to now turn to the Q&A. I think there are a few questions that Jared has kindly already answered. So if you go through the list, there should be answers to some of these. Maybe I see that there aren't any upvoted. Oh, there are some upvoted. So as a note to all the attendees, you can click like on some of the questions if you'd like us to focus on those. I think there's one anonymous question that asks, I'd like to know how you evaluate CapEx of a company. Is this something that you already broadly answered, Jared, just now? I think there are actually two upvoted questions about CapEx. Do you want to add anything further, maybe some examples? Or
yeah, so in terms of how we look at CapEx, at the moment, we have to use public disclosure as our data source, and that is broadly consistent across the TPI Centre. It is a very limited data source, but it is a very robust one because it is in the public area, and so companies have to be very confident. In terms of specifics, if they're not disclosing it in sustainability reports, going to Investor Day presentations tends to be a useful tool when finding some of the longer term stuff. But the question absolutely hits the nail on the head. There's a lot more disclosure in Europe, and outside of that, the US, some companies do, Asia, Australia, it's absolutely less common. In terms of CapEx from oil and gas versus mining, the results of the mining were a little bit better across the board. I recommend, and I didn't say, the results are available on the TPI Centre website, so you can go look and download like every metric by metric result for each of the companies to see which companies are disclosing or which areas, which might go some way to answer some of these questions. Generally, as it was with what I said in the middle of the slideshow about companies not wanting to talk about the more challenging areas and sticking to the areas of growth, that point also relates to CapEx, where companies are much more willing to talk about CapEx invested in transition materials and climate solutions when that's an exciting growth area for the company. And when it's not, and when it's seen as an additional, it's often skipped out on. So improvements are needed almost everywhere that isn't exciting, is what I'd say about that. Although Nile Dan might be able to speak to this too.
It might just be worth reminding everyone that the significance of capex. Like, it's nothing gives a greater indication of the credibility of a transition plan than where a company is putting its money effectively, and those are long-term investments, and so really we've seen a lot of improvement. If we're just pulling back a second, so we've seen a lot of improvement in target setting. We're seeing improvement in companies specifying what they're going to do to deliver those targets. We are still at a very early stage in terms of capital, aligning the capital investment with those plans and with those targets. And it's one where, if you want to evaluate that alignment, you really do need, again, that sector specific lens, because it's very different looking at a steel company and what it's planning to do, and an oil and gas or a mining company. So yeah, just that generic point about capex there.
Maybe I could make a quick point there. It's I think, to the essence of the question, it is tough because some of these disclosures are not really standardized, especially here in the US. So it's hard to look at the direction of travel, say for like an equity portfolio as a whole, unfortunately. So we do need to go in and look at things from a bottom-up point of view, and sort of to extend the frustration just a bit. The companies do give some indications, maybe slightly more than you'd expect, in terms of like text within the earnings press releases, guidance, conference calls, and so forth. But you do have to hunt and peck for it. And then, the way they disclose, oh, we're going to spend $20 to $30 million this year on, pneumatic retrofits. Well, then you don't really tend to see that broken out in the financial statements. So I guess the short answer from my perspective is there's a lot more disclosure is needed, maybe more that is out there than you might think, although you do have to hunt around for it. And also we do see some of this spending occurring within OPEX, not just CAPEX. Again, not enough spending, not enough disclosure, but maybe a little bit more than you might expect.
Yeah, that's great. There's actually quite a lot of questions that touch on capex in the chat, so I'm glad you each weighed in on that point.
Nina, can I also come back quickly
absolutely.
on one final additional point? Is there tends to be a lot more capex disclosure than is scored yes on the standards, largely because companies will strategically use the boundaries of their capital expenditure to include things that will have already been in there, to potentially inflate the size of what they're calling green capex. So in oil and gas companies, gas is often can be included as a transitional fuel in green capex, and we see that a lot. Mining companies do similar things. They'll bundle a bunch of things in a big pot and call it transition materials. And the boundaries of this you have to be really, really careful of, and really make sure you know what's in the pot of what the company is calling green capex. That's a little disclaimer I just wanted to give everyone that's really, really relevant to the scoring on this, because companies often will talk about green capex, but we just can't use the figures they're disclosing because the boundaries are all over the place.
Super useful. Yeah. Maybe just because, Jared, I see you're typing an answer to this question about the difference between NZS and C100. Maybe while you type that, we can also have Dan answer it verbally. So can you clarify again how the net zero standard assessments overlap with C100, and whether the results are actually inputs to the C100 net zero assessment or entirely separate? How does that work? And I'm asking you, Dan, because it's also part of Climate Action 100+, and IIGCC is a member there.
Yeah, sure. And so the original design of the NZS was essentially to complement the existing benchmark by adding that sector specific lens, and I think one of the slides already kind of captured that. So yeah, where there is hopefully they sit quite nicely and they're complementary to each other. how members want to use them, of course, is entirely up to their discretion. They may, as kind of Niles pointed out, like they may look at specific areas and just want to drill into that. It's all about kind of supporting that engagement conversation, and investors are going to focus on different elements. But essentially, they fit on each of the indicators that we've talked about maps onto a corresponding CA100 disclosure indicator. And that's just essentially to give investors that use the CA100 and that are approaching it that kind of familiarity.
Thanks for laying that out. We also have a question about the just transition element. So can we elaborate further on the mine closures as a sub-indicator there for just transition that we have for diversified mining? I can give a brief start to that, but maybe Jared or someone else. Well, actually, Jared, if you would be able to share the link to the methodology note for the diversified mining net zero standard, that would be great. Then the person asking the question, Lamia Shriten, may be able to access the full description. But essentially, it's looking for a commitment that, and I'm answering this myself actually because I was involved in developing this just transition lens here. So is there a clear commitment that communications, there'll be communications about decisions to close mines and whether those will be communicated with workers and communities and local authorities affected by those closures, and also whether there's a mine closure and environmental rehabilitation commitment. So those are both on the transition out side. And in the mining sector, as we've been touching on in different ways, there's a really important transition out story and an important transition in story. And both of those have social implications. So that's broadly how that set of commitments looks in the framework. We have one last open question, and we're coming near time, so I think that suits well. The question I think would probably be for Jared. How will we continue to rate companies that aren't offering sufficient energy use disclosures or other relevant disclosures? I think maybe you can answer this in the sense of how do you generally select companies to focus on in the net zero standard? How do you select inclusion there?
So far with the net zero standards, we've been deliberately choosing the companies with better and more advanced transition planning, because it's quite a sophisticated tool. And if you use it on a company that doesn't have a scope 1 and 2 target, you just score no across the board. It's not a useful use of our time in order to use that. I'm not too sure if this is a question in relation to what I said about aggregated energy disclosures and the issues within that. Our assessments of energy disclosure are kind of binary. So companies will just score no on the questions of, is the company disclosing a kind of clear aggregated total energy sold? It's kind of more of a personal question to the carbon performance teams at the TPI Centre, who work incredibly hard to try and align boundaries from different companies that often disclose in a number of different ways into a kind of singular output that we can intercompare and then benchmark. And the CP team do an absolute fantastic job, and a lot of work goes into that in kind of bottom-upping a lot of these energy disclosures from other bits of information. And it is a lot of work to do this, and often assumptions do have to be made. So if you're interested in looking at companies' energy disclosure or like carbon intensity, when it's quite difficult to calculate, you can absolutely look at the carbon performance tool on the TPI website for that.
Great, thanks. Thanks, Jared. We're coming now at time. So I'll just summarize a very short set of takeaways and sort of key phrases that came out. So the transition is business critical to these sectors in particular, and that's why investors need to be able to interrogate transition plans. I really appreciated how Nile talked about the net zero standard results as a treasure map. So it's helping investors identify those opportunities, but there's also this important lens on the just transition element there. Dan mentioned transition as a systems change. So not only ramping down some activities and commodities, but also ramping up So I just want to thank you very much to our speakers, Nile, Dan, Jared, Ella, and David. Really appreciate the time. And to all our viewers, thank you for joining. We hope you found this interesting. Please check our website for any latest data releases and methodologies, transitionpathwayinitiative.org. Thank you so much.
Thank you everyone for joining.
Bye.